From last time, what did we learn?
Income statements.
Right. There's 3 financial statements, and we talked about income statement, right? And income statement is what?
Revenue minus expenses equals net income.
Exactly. Revenue minus expenses equals net income. And we talked about these 3 parts of it and all that kind of stuff. The next one I want to talk about is a balance sheet. And a balance sheet, they call it a balance sheet because the 2 sides have to balance. And we usually set it up like this. Sometimes you see it set up like this with assets on one side and liabilities and equity on the other side. Sometimes you'll see them where the assets are on top and then the liabilities and equity are below, and it's stacked this way. But this is the usual format, and the one that we'll talk about. So we talked a little bit about this last time. That you have all these different asset classes. Liabilities mean what? It's what you owe. So if you have a car loan, if you have payroll, if you have an electric bill outstanding, all that kind of stuff, those are liabilities. And equity is what's left over after the liabilities are paid. This is what the owners of a company or your net worth, right? When they talk about your net worth, because we all have personal balance sheets too, right? So this is the net worth, and they call it the net worth because it's the liability, the assets minus the liabilities equal that. And the sum of all the assets have to equal the sum of the liabilities and the equity. So basically, and these 2 things here fund the assets. That's how you buy assets, is with either cash or money, from investors or yourself or whatever, and some sort of borrowing from a bank or something. And that's how you buy an asset. When you buy a car, right? You might go in and buy a car. You might put, some money down on the car and take a car loan, and you get the car, right? So this is how you fund assets. There's a thing called the accounting equation. And the accounting, this is like the big equation of accounting, right? Assets equal liabilities plus equity. It's basically saying this. So I want to put this into a, because this isn't that intuitive, right? This one is, you get your money, you have your expenses, what's left over is what you get to keep at the end of the month, kind of thing, right? This one's maybe not as intuitive. So think about it. If you think about it like a house, a balance sheet, then you'll always know what it is, and you'll never be. My most thing I want to convey to you is not to ever be intimidated by this kind of stuff. If anybody ever starts talking these kind of numbers, or your boss or boss's boss or anybody in accounting or finance, you'll never be intimidated to look at these kind of number sheets and say, hey, I don't understand this, because you know enough that it's like, this looks like gibberish to me. You'll know enough that you won't be intimidated, So, anybody own a house? Or ever think about wanting to own a house? You own a house, right? You own a house, right? Where is it?
Tucson.
In Tucson. Anybody else? Everybody rent? But you own a house? Yeah, so, but you, that's something we all kind of know about, right? So with a house, it's set up just like this, right? When you buy a house, you put down a down payment, right? That's this number here, right? Your down payment. And then you take on a liability, and what's the liability called for a house? There's a special name.
Mortgage.
A mortgage, right? A mortgage. But all that is really is just a loan, right? Liability is just another name for loans. All these kind of names are the same thing. Debt, bond, liability, mortgage, they're all kind of synonymous, right? They all mean the same kind of thing. So liabilities are kind of different in legal terms, right? You might have a liability means that they might be able to sue you for something, right? You might be held responsible for something. And in this, it's kind of like you're held responsible, but liabilities are are all your debts, all your obligations that you owe. So you put down a down payment, right? And you take on a mortgage, and those two things together, what do? They buy the house, right? And how do you determine the value of the house?
Market, supply and demand.
Well, when you go and get a house or something, right? Supply and demand, but how does it's an appraiser, right? Appraisal. You ever hear that term? And what an appraisal does is look at comparables, sales in the last recent sales in the neighborhood, and then sort of adjust your property to match those recent sales, because not all houses are the same, right? One down the block might have sold for $250,000, but it had an extra bathroom and bedroom, and so you'd have to take those off, and say maybe that's 50 grand, so or 50 grand, and so now yours is worth 200, or maybe it's has a bigger lot, or you have a bigger lot, and so they make adjustments and they take and then they also, not only do they look at comparables and the market, right, but they also look at replacement value. Like if you had to build this house right now, how much would it cost to get all the lumber, get the guys to come over and hammer it together and put a roof on, all that kind of stuff? What would that cost? And so you get these different numbers, and then you sort of triangulate a value based on that, and it's all set out in a big, document. And that's what appraisers do. And that changes, right? The appraised value changes over time. That's why everybody's interested. What did that house sell for down the block? That means I bet my house is worth more now. And everybody gets all excited, right? And so appraisal, the value of the asset is something that changes, right? It can change over time. And with houses, it can go up. What happens with a car, It goes down, right? It goes down pretty fast when you drive off the lot with a new car. Suddenly, your car the loan might be worth more than the car when you drive it off the lot. And if that happens, how much equity do you have? Like zero, right? And that's what. So if your house is worth $250,000 and you have a $150,000 loan, how much equity do you have? 100 grand, right? Because this number, this 250 has to equal this 250. That's the balance part. They have to equal each other. Every time, all the time, no ifs, ands, or buts, it has to balance. And that can be difficult when you're doing your accounting, because a lot of times you make mistakes and they don't balance out, and so you have to go back and figure out where the mistakes are. Have you ever had that kind of? We have to reconcile the bank statements or whatever. It's like, wait a minute, it's just something. And then finally you figure out that you flipped, a debit and credit, or some kind of input, or you just you transpose numbers, but that can take a long time sometimes to figure out where the heck you made a mistake. But they always have to equal each other.
A trick about dividing by 9. Do you know this trick? Like if you've got, I can't remember exactly what it is, and it works in some situations, but not in all. But if you're off by like an odd number, you can divide by 9 and find. I'll have to go back and
please look, because I haven't heard that, and I'd love to know what that is, because that could be important.
Kind of figure out maybe what transaction it was based on the amount, or it's the difference of the 2 divided by 9 or something.
Oh yeah, please, I'd love to know. I haven't heard about that.
See if you can find that.
Yeah, so does this make sense? If you just think about it, so whenever you think about balance sheets, just think about a house. You got the asset is the house, and it's the value is made by some sort of market consideration, in this case appraisal. You have some kind of debt, in this case called a mortgage, but it could be bonds and bank loans and all that kind of stuff. And your what they call current liabilities are things you got to pay with the GAAP rule is that whatever you have to pay within that year is a current liability. But a lot of times it's monthly too. It's like you get the electric bill or the rent bill. And you don't maybe cut the check right that day, right? But you acknowledge you have it. It goes in as an accounts payable, like you're going to pay it later, and then you pay it at a later date. So you have these current liabilities like salaries and rent and all that kind of stuff. And then you have long-term liabilities that might be like a 5-year, bank loan, or 10-year bonds or something if you're a corporation. And then what's left over is the equity, and that's distributed to the owners, depending on how much of an ownership stake they have, right? If you own 100% of it, then all of this is yours. If you own, 16 or 18% of it, like Jeff Bezos owns, I think, 16% of Amazon. So when it's a $1 trillion company, he's, 160 billion net worth kind of, thing. So whatever your prorated share is, your percentage share of it. If you own half the company and it has $100,000 in equity, then you have 50 grand, whatever that is. Same thing with a house, right? What do they call this number? If you have, house is well worth 250 and you've paid down the loan or something and it's 150, this number is called homeowner's equity, right? That's where that number, and you can borrow against that. You shouldn't, but you can borrow, get a homeowner's equity line of credit or something. That's based on how much equity you have, right?
So what happens
Yes,
if
Rosalie.
you don't have equity? For example, you have a loan of 250, but the house value is 150.
That happens a lot, and that's what happened in like 2008 and in other times. Yeah, you can, and companies, that happens with companies. Then you're basically you're not solvent. You're basically bankrupt. That's what happens with companies when they go bankrupt. You're underwater. When a house is like that, they call it underwater or something like that. It's basically that your loan is worth more than the house, and a lot of people back in the day walked away from their houses because it was like that the price dropped so precipitously, and they were left with a big mortgage. Like, I'm gonna walk away from this. It happens with companies. So that's what happens with banks. That's what happened in 2008 and in other banking crises, right? Is what is a bank but a bunch of assets that they're holding, and it might be securities, like underlying those securities might be home mortgages or stocks and bonds. If the market tanks and they owe money, suddenly their equity gets wiped out, and the bank is wiped out and in foreclosure, and then the loans that the other bank was holding of this bank, then they're worth nothing, and so all of a sudden there's this ripple effect, and that's what happens when we have a financial crisis. Yeah, but that's exactly right. That's what this doesn't change, right? That's the thing. This is fixed. This is not fixed, and so this is where it takes the hit.
So if you were to show this on your balance sheet, that your loan is for $250,000, your house loan is, or your asset of your house is $150,000, you're going to show a negative $100,000 net worth right there.
Exactly.
So when you walk into a bank and take this in with you, it's going to show, hey.
Yeah, they're going to want to see your
here's my negative.
Yeah, they want to see your
This is worth
personal.
the whole.
What's your net worth?
Yeah.
And your net worth will have all your. What's the cash in your bank accounts? What's your car worth? What's your furniture worth? Whatever other securities you might have or other kind of things. And then what do you owe? Do you have a car loan? Do you have a credit card bill? Do you have a mortgage? And those things. The difference between those things is your equity.
And so
your net worth.
On that balance sheet, when you're looking like at assets, just in a personal setting, you're not counting future revenue, right? Like if you have a job where you make $100,000 a year, you're not putting that down. You would add it there.
No. That's an income statement thing.
Oh, okay.
Right? That's an income statement type of thing. And we'll get to that next. But yes, basically, you won't show future revenues, but at the end of the year, what's here, the net income, there's two things you can do with the net income at the end of the year in a company. You can distribute some of it to the owners, and that's called a dividend. Or you can put it into equity, right? And that's called retained earnings. So a lot of, and then that gets added to your, bless you, that gets added to your equity each year. So yeah, a lot of companies like say Apple, IBM, they dividend out some of the money to the stockholders. The rest goes into retained earnings, and they use that to run the business going forward.
What do you see?
But you don't put your future earnings in there. No,
Okay.
not in the balance sheet.
What do you see small businesses doing the most of? Do they take most of the money out of the business, or do they put it back in?
It depends. If you're a growing business and you need the money and you want to grow and you don't want to take on investors or whatever, which is a good idea, then you'd probably plow a lot of it back into, if you had prospects to grow it. If it's a mature business and it's not really growing too much, you probably take out more. It's what they call a cash cow, and you don't need to put in that much. And that happens with a lot of stock, companies that are on the stock market. Companies like Google or Facebook, they're growing really fast. So they know that if they keep, or Amazon, right? If they keep plowing in the money they make back into the company, they have great opportunities to grow and get more market share and get more customers and make more money, right? But companies that are more mature, that don't have those great prospects for super duper growth, then the stockholders or the owners say, give us that money because we have better ways of reinvesting it than you do in the company. So then they start advocating for raising the dividend rates. So mature companies dividend out more of their money, and growing, growth companies retain most of it. Like Google, Facebook, Amazon, they don't have any dividend. Everything gets plowed back in. And people buy that stock thinking that they're going to grow more and the stock's going to appreciate in value, and that's where they're going to make their money. Other companies like even Apple, IBM now has a yield of about 5% that they, of the stock. If you buy the stock for $100, they'll give you $5 a year. 5% goes to as a dividend. So it's a nice dividend that you get. The stock can still go up if they're doing really well, but you'll also get this sort of like income from the. You're not just worried about just banking on the appreciation of the asset. So it depends. It depends on the company and on the situation,
So if you're not paying it, so for example, I take an owner's draw.
But you take an owner's draw as probably as an expense.
Okay, but it's taken out of equity.
Sure.
Okay.
Yeah, and those things are taxed differently, and you probably want to talk to your tax person about, is it better for you to take it here, or is it better for you to take it here, or is it better for you to take it both places, and in what kind of mix? That's the beauty of being the owner. You can give yourself a raise, or you can give yourself a bigger dividend.
But then you have to file a Schedule K, and you gotta right? Isn't it a Schedule K that does dividends?
Well, if it's an LLC, is that what you? Yeah, an LLC, a limited liability corporation. Yeah, you file Schedule K is how many owners you. And if you have more than 2 owners, when you change ownership, if you bring in the distribution stuff, math gets very, very complicated, and you end up spending so much on accountants, it's not worth doing. Then it's good to become a corporation. It's much easier than to do those kind of distributions.
I don't like sharing my toys.
Excellent questions. Yeah, right?
What was it? So you said you're a what?
I'm an LLC, a limited liability company.
But before that, you said what you do with the.
Oh, I do an owner's draw.
What's that?
So it's like a paycheck.
Yeah.
So,
Yeah.
yeah, it's
It's your paycheck.
from the business. We
Yeah.
don't pay.
Okay.
We don't pay salary. Really, it's all taxed at the end of the year, and we do an owner's draw.
Mm-hmm.
And so, I don't get paid an hourly wage. I'm not going through payroll or anything like that. I take a $800 a month draw, and then at the end of the year, it comes off the top, and then it's taxed on my personal taxes. Now I've got to put into an account, 15 to 25% of that money to hold off for federal taxes, and then I have to every quarter pay an estimated tax amount of what I think my income is going to be for that year.
Okay.
Now there's also tax-wise, this number gets taxed, right? So if you're taking a dividend, it gets taxed here, and then this money goes to you and it gets taxed again, the money you get, so you get double tax. So sometimes it's better to take it here, and then you're taking it pre-tax here, and then you get taxed at the personal level.
Which
That's
I
all
think for
tax
us
questions.
Is probably the best.
Yeah.
So
But those are high-class problems to have.
the income gets
First roll.
taxed, but business expenses don't get taxed.
Yeah, so business expenses, like if you're paying your light bill and your rent and all that stuff, that's not considered profit to you. That's not considered income to you. But like an owner's draw would be income to me.
Okay.
Even though it's not really, I don't account for it under expenses. I account it as a negative against owner's equity. So at the end of the year, I have this net income. Let's say I have $10,000 net income, and I've taken off the top $5,000. So that net income is $5,000, and at that point, I can either decide to take that money as an owner's draw, or put it back in as retained earnings.
As retained earnings, yeah.
Back into the business. But it's not really an expense. It's kind of one of those gray areas. It's a negative against your company's
But
equity.
when you talk about taxes and what gets taxed, you have your revenue, right? That's how much the money that comes in. In your case, it's your rent or whatever. And then you have your expenses, and that's all your maintenance, all that kind of stuff. And then you have the net income. And this is, and then they sometimes call it, earnings before interest and taxes. It's EBIT. And because then you take the interest off, because interest is tax deductible. But then that number gets taxed, right? There's a tax rate, and you take some tax up minus the tax, and then this is the income after tax, right? So this is where taxes happen. The expenses don't get taxed. And so if you're really, savvy at this kind of stuff, lots of companies, they make this number, they get their expenses to be just about, make this number very efficient for tax purposes. If you could find many expenses as you had revenue, then this number would be zero. You'd pay no taxes, right? And if this number is negative, you have a loss, then that becomes a tax loss carry forward, and you can charge that against income you make in the future, and say keep your taxes down. That's what our president does.
So like small businesses that maybe start out and go into debt.
Yeah, you make a loss.
And so you said what? The next year?
You can take this loss against income you make in the future.
So let's say you had a negative $10,000 at the end of your first year. Next year you start negative 10,000. So even if you make $100,000, you're really
90.
only being taxed on $90,000 because you're starting in the negative.
Oh, okay.
That's getting kind of sophisticated, but and taxes can get. My best advice is get a good tax accountant. Get a good accountant that you talk to about all that kind of stuff when you start to make money.
And one of the nice things about taxes is when you buy assets for your business, whatever that is. So like since you own a home, if you were to buy furniture for that home, all of that can be
Becomes expenses. Get written off.
Yeah.
When they say written off, it means you can expense it.
No. Well, you subtract all of the expense out of your income, and then when you file your taxes, there is, I want to say it's like, I can't remember what it's called, but it's a law that allows you to take the total expense off of your profit.
Because on
Do you know
my
what I'm talking about?
Intuit, the not TurboTax, but the other one, like a small business. it
Quick
says only-
QuickBooks?
QuickBooks. It says it only allows us to like $700 part of because the furniture, that's our assets, because that's something that's
Well, now
like
we're gonna
50-50.
now we're gonna talk about that.
And,
There's
our
two different.
personal use and business. So.
Well, yeah. Then it's
That's
yeah.
different, right?
Okay.
Yeah, it's different if you're gonna use it personally, but if it's
Well, I mean, it's our
specifically-
house, so we'll move back in eventually. and
But
so-
you're renting it now, so you may be able to take it off. But there's two ways you can do it. You can expense it, or you can capitalize it and make it an asset on your balance sheet. And now let's get into that. That's the big thing about. We've been talking about all this kind of stuff. Now there's the next. I'm going to erase this. Okay, the next big subject to talk about, now that we kind of know income statement and balance sheet, right? I'm just going to give you a little quick. A balance sheet is just a picture in time, right? It's just a snapshot. It's what the house is worth now, or what all your assets are worth, right? So you usually have one of those at the end of the year, let's say, right? And so say this might be for, the end of 2017. Now, during 2018, last year, right, you would have an income statement, right? And that income statement would be all the revenues. This would be the assets, liability, and equity. All the revenues, and then all the expenses and the profit that was made, right? And then we're going to have a balance sheet at the end of this year, right, 2018. And so this is what happens during the year, and these are the two bookended things of those years, right? So, and what we just talked about was that the net income can be dividended out, or it can go in as retained earnings. And by retained earnings, it means it would be added to this. If you made, $100 in profit, then it would be the equity from here plus 100, right? Make sense? That's how these things are kind of connected. Now there's another one down here called the cash flow statement that we'll talk about that basically does some adjustments. But for now, this is just so you can start to see the flow of these things. And that's how you increase your equity. And that gets offset basically by an increase in your bank account, in your cash position. And that's what the end of the cash flow statement gives you, the cash, and that goes there. And then these things, once again, will balance out, right? And so the cash flow statement starts with net income and then makes some adjustments, so we'll talk about that. But just conceptually, as you start to see this, right? So this is the one that goes through time, and these guys are just like snapshots. And they change based on what happens during the year, right? If you lose money in that year, it's going to be equity minus whatever that is, right? That'll be the math of it. So, does that kind of make sense? Just as a...
So then, when you add like the equity plus the 100, that changes your assets.
Then this number will be bigger, right? And then the cash will balance out. It's going to change this side by $100 plus, right?
Yeah.
And then this side has to change by $100 too. And it's primarily the cash account that at the end of the cash flow statement, when it does the reconciliations from net income to actual cash, that goes into that. Then this number has to equal exactly what's in your bank account. And that's where the reconciliation means here's the bank account, it says 15 grand. This number has to be whatever this number is, cash, plus this number has to be 15 grand to the penny. And that's where accountants go nuts because, inside of a company, because it's a lot of times there's a little mistake somewhere and you got to go back and find it until they actually balance. Just to give you that kind of an idea about where we're headed, right? And we'll talk about the cash flow statement. But first we got to talk about why we need a cash flow statement. Why do we need a cash flow statement? Well, you want to know what cash is, and liquidity means just is it can you actually transact with it? So it's cash. The reason you need it, and these words always used to scare me, and I didn't know what they meant, but there's two kinds of ways to do accounting: cash and accrual. And a lot of people say, do you do cash or accrual? And cash or accrual, what the heck does that mean? And I'll give you a hint, we all do accrual. We don't do cash accounting. The reason is that when you start doing a company, maybe a really simple company, like say a delicatessen, somebody comes in, they order a sandwich, sandwich is $5, they give you $5, you give them the sandwich. That's it, right? But when a company gets a little more sophisticated, or even like in that case, it might be a catering kind of deal, right? Where they do catering and suddenly somebody comes and says, I got a wedding, in 2 months, I'll pay you now. You cater the wedding in 2 months, I need 75 sandwiches or whatever, And you get the money now, right? But you didn't actually do the service yet. And so it can get really jumbled when you start to invoice people. You've done the service, or you gave them the refrigerator, and then you invoice them and they have 60 days to pay or something like that, or 30 days to pay. That starts to get dicey, and you can't really use cash accounting. So accrual accounting sets up several new accounts that are non-cash, right? That cash didn't change hands yet, but it's going to at some point. Like I said about the electric bill, right? You get the electric bill in the mail, it might come on the 14th of the month or something like that, and you say, okay, got the electric bill, it's $90, we're going to put it in our books, we know we have to pay it, but we're not going to cut that check till the end of the month or something. And then that becomes an accounts payable, right? Something you know you have to pay, it's a liability, but you haven't paid it yet. Same thing on the other side. We sold, 5 dresses, and they're going to pay us in, whenever, that's an account receivable. You're going to get it, but you haven't gotten the money yet. So it didn't impact your cash yet. In both cases, right? You haven't paid, so the cash didn't leave your account yet for the electric bill, and you haven't gotten the money from the customer, so the cash hasn't come in yet for the dresses. But you want to book those kind of transactions when they haven't, right? And that's called the matching principle. That's like the key to accrual accounting. And the matching principle, it's basically so that people on the outside can understand your business, right? Your banker or your investors or the taxing authorities or whatever, people that have to understand your business. You can't say, wow, you had a great month this month because you made $1,200 and you had no expenses, and wow, you made $1,200. But you say, wait a minute, that $1,200 is because I'm going to cater a wedding out here, and it's going to cost me, $900 for all the stuff. So I'm really going to make $300. And then out here, you didn't really make much money, but you spent $900. Like, oh, wow, you had a terrible month. You were down $900. People wouldn't be able to read if it's a cash business, wouldn't be able to read your financial statements accurately because they need all that information, right? So what we want to do, the matching principle is we want to match a cost with a revenue, right? An expense with a revenue when they happen. Whether the money's come in or whether the money goes out, you want to match a revenue, with an expense, right? So when somebody says, I'm going to buy that 740, American Airlines says, I'm going to buy 10, 747s from you, Boeing, deliver them, and then, we'll pay you, and then that'll be a sale, right? The sale will be booked, and that'll be an accounts receivable, and, you've actually even delivered the planes, and they're going to pay in 90 days or something like that. That's why I don't know if any of you ever worked as a accounts receivable clerk or anything. Basically, what are you doing? You're just hounding people that haven't paid, right? Pay your bill, pay your bill, pay your bill. And not everybody pays, right? Accounts receivable are more risky than the actual cash revenues you got, because the cash revenues, you got them in the door, that's done. These people that maybe 30 days go by, 45 days go by, 90 days go by, maybe some of them never pay, right? So you have to make a little maybe allowance for bad receivables that aren't going to come in, right? So the accounts that get made, the basic ones, are on both sides of the balance sheet, right? You're going to have your assets, and one of your assets is going to be cash, right, the top one. And right under that's going to be accounts receivable, the revenues that haven't come in yet, but that are going to, come in, right? And on this side, you're going to have your liabilities, and one of those early ones in the current liabilities is going to be accounts payable, the stuff that you need to pay relatively soon, but you haven't paid yet. So it hasn't hit your bank account yet, but you've booked that as an obligation you have, and you've booked this as a sale you've made. Those make sense? So when we're talking about a cash flow statement, that's what it's doing. We just did it the simple way before, right? But how much of this revenue number is accounts receivable? This number is overinflated from a cash standpoint. Say 20% of it is in AR, right? Then this number, say if it's, whatever, $100 and then $20 in accounts receivable, then this number here is overstated from a cash standpoint by $20, right? So when we do the cash flow statement, we're going to start with this, and we're going to have to take away $20 to get closer to the cash number, right? Same thing with expenses, right? That electric bill, you haven't paid it yet, it's $90, right? You have it in here as an expense, but it didn't hit your cash yet. So here, your cash is understated by $90, right? So we'd add back the accounts payables, 90, and so these things would be adjustments that you make to try to get to cash, right? Make sense? This is some of the hardest concepts, and we'll go back over them. You can read about them and stuff too. But doing accrual accounting. So really, the big accounts that get created by accrual, matching a revenue with expense, are accounts payable and accounts receivable, right? And there's one more thing like that we have to know about. Anybody ever hear the word depreciation or amortization. They're almost synonyms, basically depreciation and amortization, and they're similar kind of things to give a more accurate picture of your operations, right? So say if you buy a truck, right, and it's going to be a delivery truck, and you pay $10,000 for it, right? You don't want to expense that whole $10,000 in that year, because then your expenses are going to look really giant. It'll look like you have a big loss, right? And then you're going to use it for the next 5 years, and in those years you're not going to show any usage of it, and so those years are going to look really good, and this year's going to look really crappy, right? So what do you want to do? You want to spread out that cost across that 5 years. You estimate the useful life of whatever asset you buy. If it's a machine, if it's a whatever. If it's furniture.
So I just looked up that tax law that I was thinking about, and it's section 179, expense deduction.
Oh.
Yeah, and so what it allows you to do is take so you don't get to depreciate your stuff. So you really got to decide where your value's going to lie when you do this. So it's section 179, expense deduction. And it'll allow you to take the total expense of the asset against your taxes in the first year that you buy it. And so you can either do it that way. So if you're going to have that your operating expenses in your first year are going to be really big, you can apply all of that asset write-off against your taxes and bring that down to zero, so that if you're going to make money the first year.
If you're going to have big revenue, yeah.
Yeah,
if
you're gonna have
not,
big revenue.
right.
But if you know that you're not going to have big revenue, but maybe the second year you're going to have a very high increase, you're going to want to depreciate it like this.
Right, and that's a decision everybody always makes: is should we expense this or should we depreciate it?
Can you explain a little more so I can understand?
You bet.
What you were saying first, you can do it.
So it's like a lump sum, or it's a percentage of the cost each year. So if you're, so for example, in my first year of business, we made a profit of like $9,000. We were open 3 months and made $9,000. I wrote off the whole expense of every asset. Now again, it only cost me $20,000 to open my business, or $25,000. So I took every dime and put it against that $9,000 so that I wouldn't have it.
To bring down your tax bill, to bring down that net income.
Yes. So you might not have the same thing going, because if your profit is less, if you're not going to make a large amount of profit, you don't need to write those assets off. It all in the first year, you can carry them forward.
A lot of times what people do is you can do it that way, or in a bigger company, they have like a cutoff. So anything under $1,000 that you buy, just expense it. Anything over $1,000, maybe over $2,000 now, we're going to capitalize it and put it on the books as an asset and depreciate it. And what depreciation just means is that, so either say if you bought something for $5,000, right? You could take that in the first year, like you say if you had $30,000 worth of revenue and you wanted to take that whole expense, you could expense it, and then you'd have 25 grand down here. But if it's something you're going to use over 5 years and you want it to be accurate, right? If it's a big piece of equipment, you might want to say, I'm going to take a depreciation of $1,000 each year to show the useful life of that asset and make this make more sense as far as what we're actually using, instead of having 1 year with a giant expense and then showing no expense here, and these years look great. So this is it's a way that it impacts your income statement and your balance sheet, right? If you expense it, it doesn't go on the balance sheet. If you do capitalize it, then you'd have an asset of $5,000 over here, right? Say for truck or machine or whatever it is, you'd have your cash up here, but as you go down the lines, you'd have this, right? And then you take depreciation, and each year you take $1,000 off of it, and then you'd have netted depreciation. In 1 year it'd be $4,000. The next year it would be another, $1,000 off of that, and then it would be worth $3,000, and that's what you'd be carrying on your books as an asset as it gets depreciated to zero, right? And that would show more clearly how you're using that asset over time.
You also can, now, once you make a decision about which asset you're gonna account for in which way, like if you're gonna depreciate, like let's say you buy a car, and you're gonna depreciate that car over the 5 years, you can't change it once you've made the decision. Once you-
Depreciating it, are you meaning like taking a longer, like time to pay it, or?
No, taking a longer time to show.
To
its
account for it.
to account for it on your books.
Okay.
To show it as an expense on
So
your books.
instead of that 1 year, you're charging like 20,000, you're gonna divide it up.
Yes.
Yeah, divide it up. And if you're going to use it for 7 years, you divide 1/7 a year. If you're going to do it by 5 years, 1/5. If it's a 3-year kind of thing, like a computer, maybe 1/3. You know, so that is depreciation. Depreciation you do on tangible assets. Amortization is what they call it when you do on an intangible asset, like money that you paid for trademark lawyers or a patent or something like that. Just called amortization. It's the same thing. Software.
Amortization.
It's the same concept. It's just a different name.
So like for example, let's take your couch. So you got your couch, you spent $1,000 on it. You want to lower your tax bill to 0. You're going to totally write that off in your 179, right? The section 179. Write off $1,000, lowers your tax to 0. You also have another piece of furniture. Let's say it's your dining room table, and it's also $1,000. Well, you can take. You're going to say, oh, I'm going to use that for 10 years. So this year, I'm only going to write off $100 of that. And then next year, $100, and next year, $100. So you don't have to do every asset the same. You can account for them differently.
And that will just show you're making money rather than, that year, rather than like breaking even or losing money, like by depreciating it
just,
over time.
Yeah, it just helps you manage your tax liability in a lot of ways, so that you're not overpaying the government for nothing.
Right. You have to pay your taxes, but there's no law that says you got to leave a tip.
Yeah.
But so this is for managing your taxes, but it's also for, even more important from an accounting standpoint, it's to make a clearer picture of your operations. So if you have outsiders like bankers or investors or shareholders or whatever it is, or taxing authority, you want to show a clear picture of how your business is operating. So in that case, you wouldn't want to expense a giant thing in 1 year and then have these years not have it, because that's confusing. It doesn't show. Just like we were talking about with when the money's going to come in and go out, you want to have a clear picture of, we bought this asset and we're going to use it for 7 years, and so we're going to take 1/7 of it each year to clearly show how our business is being operated. So what we'll do next time, because we're getting we got some time, but there's 3 videos on Khan Academy about accrual versus cash accounting, and Sal Khan does a great job. So we'll just watch those. They're like 5 minutes each, and then we'll talk about this again, because this is the hardest concepts to figure out. What a cash flow statement is, how you use it, and then how these things flow together. But really, basically, the fundamentals are a balance sheet and an income statement, and what we've talked about: revenues minus expenses equal net income, assets equals liabilities plus equity. That's really, if you just remember that, you've remembered it all. This stuff about accrual and depreciation and all, we're getting into some more nuanced things. And if you haven't thought about these for quite a while, if they're new concepts, believe me, it takes years to really start to internalize this stuff and understand what it means. But it's not difficult, but it'll take you a little bit of time, to wrap your head around these things. And we'll go through these again next week. And that's all we got to do, is just go through these things over and over until you really kind of understand them. And the book and the online course will help you. And there's lots of other things online you can learn about that too. And then we'll talk about it more too in the accounting course. But this is just to give you an idea about accrual and why accrual makes sense.